types of investors, right? There's essentially three types of investors. A passive investor invests in other people's deals. Basically, they provide the money for for basically a stated return, a piece of the action, something that they'll get on the back end, but they're in it for the return on investment, right? I'm going to put in 100,000. I'm going to expect to get back 8% a year for 5 years, whatever, right? Whatever the deal is, right? They don't have any management control, right? So they're completely passive in the deal, right? Now, being a passive investor is a nice way to get some tax-free cash flow. We'll talk a little bit about that in a minute, but you don't really get a lot of tax advantages to it because passive losses are only, you can only offset passive losses against other passive income or capital gains from real estate. You can't reduce your W-2 or business income with losses from passive investments. Okay, you have to be active in order to do that. An active investor is somebody like what I used to do, or what I was just describing from the real estate agents. Somebody who buys their own deals, maybe manages their own deals, does their own flips. That's it may be their business, right? Or it may be something they do on the side, but they do it actively. They're actively engaged in it, right? They're making the decisions. They're calling all the shots on the deal, right? So they're an active investor. An active investor is allowed to deduct up to $25,000 of rental losses a year against their ordinary income, against their W-2 income or their business income, assuming that that income does not exceed $150,000 a year. So once you go over $150,000 a year of other income, you lose that ability to deduct rental losses, and those rental losses become a carryover, just like the passive investor doesn't lose his rental losses or his or her rental losses. They just get carried over to the following year. We'll talk a little bit more about that in a minute. But same thing with an active investor over 150,000. If you're an active investor and you make over $150,000 a year, you're essentially a passive investor because you can't deduct the rental losses against your ordinary income. Now, the holy grail of investor types, the one that allows you to deduct unlimited amount of losses against your ordinary income, is what's called real estate professional status. And in order to qualify as a real estate professional, you have to have at least 750 hours of real estate activity in your business, and it needs to be more than 50% of all your business activity, right? So if you have a W-2 job and you're working 2,000 hours a year, right? It's really, you might have 750 real estate hours, but you really need 2001 real estate hours. So it's got to be more than 50% of what you're doing, right? So you have kind of have to keep that in mind, whether or not you qualify. Now, here's something that's kind of cool. If you're married, your spouse can qualify. So we have a lot of high income individuals who whose spouse is interested in real estate, and we try to, we tell them, we consult with them on basically how to get real estate professional status for their spouse. Maybe their spouse has an interest in real estate, but they're not working currently, in something else, or they have a part-time job or something, and they can put those 750 hours in, managing properties. So we have a methodology. We help people, design portfolios that are a little time intensive, right? Kind of investments that you have to, actively manage, or manage construction or that sort of thing. They take time to do, and we get those spouses involved in that. We get them to qualify as a real estate professional. That's a really good strategy if you can do it. Now, if you're already in the real estate business, you don't have to do that. You already qualify, right? So all the activities, so people always ask me, like, what qualifies? All the activities related to the operations and marketing of a business qualify. And there's certain types of real estate businesses that qualify. And those businesses you can see on the slide are real estate development, real estate redevelopment, like flipping houses or renovating apartment buildings or doing conversions, construction, home building construction, or building commercial buildings counts, doing like syndication, like acquisition of properties counts. Rental operations and property management, just running your own rentals or managing properties for others counts. Being a leasing or brokerage agent counts. So all of those business activities can qualify you as a real estate professional. And what that does is it opens up the whole world of strategies to you, right?